Thank you for watching. Please like and subscribe to our channel.
To the explainer. You know, if you've even glanced at the financial headlines lately, you'd totally be forgiven for thinking the sky is literally falling. I mean, global tech stocks, they've been in an absolute freefall. We're talking red across all the major indices, and the financial media is just screaming about the end of the AI bubble. But hey, as always, we are not here to panic. We're here to understand. Today, we're digging into a massive mystery in the markets right now, because beneath all those terrifying headlines, something incredibly fascinating is actually happening. It turns out, the story the crowd is buying into, it's fundamentally flawed.
Get this, $119.2 billion. In the exact same week that global tech stocks were supposedly crashing and retail investors were hitting the panic button, a record-breaking $119.2 billion flowed straight into U.S. stocks. That's literally the largest weekly inflow ever recorded. Just think about that contradiction for a second. The market is supposedly crashing, right? Yet we're seeing the biggest tsunami of incoming cash in history. No way that adds up.
Okay, let's dive into this. When you contrast the absolute panic of the crowd with the calm, cool assessment of institutional Wall Street, a totally different picture emerges. Wedbush Securities, they're a huge player in market analysis. They aren't calling this a crash at all. Nope. They're calling it a, quote, healthy pullback within the broader AI boom. They definitely aren't running for the exits. So the market is sending out these massive mixed signals, leaving your average investor completely caught in the crossfire. But today, we're going to play financial detective and decode what's actually going on.
Which brings us to the $19 billion question. If the tech sector is supposedly dying, where exactly is all that historic cash going? It hasn't just evaporated into thin air. So our theme for this explainer is super simple: follow the money. If we can track where that capital is flowing while everyone else is distracted by falling software stocks, we can uncover exactly how the smart money is positioning itself for the next big phase of this market.
Which leads us to our first section, the mega rotation.
Right now, we're seeing what analysts are calling a mega rotation. And the absolutely crucial thing to grasp here is that the money isn't leaving the stock market at all. It's just executing a massive, highly strategic shift. It's moving out of one specific type of asset and aggressively pivoting into another. Let's break down the sellers versus the buyers. Smart money is dumping overvalued AI software companies, specifically the ones caught up in the hype cycle that literally have no clear path to making actual money. They're also ditching consumer tech that's facing heavy regulatory pressure, like the new enforcement of the EU AI Act. But look at what they are buying. They're buying the physical foundation of the AI revolution. We're talking AI infrastructure, commodities, high-yield dividends, and corporate spin-offs. It's your classic gold rush scenario, you know? The smart money isn't out there panning for gold. They are quietly buying up all the picks and shovels.
Moving on to Section 2, AI's physical revolution. We are transitioning completely away from that dying software hype cycle. While the media is totally obsessed with software interfaces and shiny new apps, there's a quiet, highly profitable physical revolution going on. Look, to build the future of AI, you need massive data centers. And those data centers require incredible amounts of physical materials. And the most unlikely fuel of this boom? Tin. Yeah, tin. Forbes actually just reported a massive surge in demand for this commodity simply because tin is absolutely essential for soldering those advanced AI components together. So while the amateur crowd is blindly chasing the next overhyped software startup or just obsessing over NVIDIA, the real smart money is quietly buying up the raw, unglamorous materials you need to physically build the AI infrastructure.
BBC Business really hit the nail on the head here. They said, follow the money, the chips powering AI. Despite the broader tech sell-off, chip stocks are already selectively bouncing back from what traders call oversold conditions, which basically just means they dropped way too fast too soon. And why are they bouncing back? Because the underlying demand is just insatiable. Major tech companies are literally cutting jobs in other, less profitable divisions, specifically so they can redirect hundreds of billions of dollars straight into AI hardware. Plus, we're seeing a wave of upcoming IPOs from AI rivals just racing to list their shares. The capital is flowing directly into the hardware foundation.
That brings us to Section 3, hiding in plain sight. Let's shift our investigation toward another huge opportunity created by this rotation. Whenever a market goes through a mega rotation like this, incredible value gets left behind. The baby gets thrown out with the bathwater, and that creates some really remarkable value plays for anyone who's actually paying attention. For instance, check this out, an 8.7% dividend yield. That is a massive yield, and it's currently available in select, deeply established tech stocks. We aren't talking about speculative fly-by-night operations here. These are mature businesses generating huge piles of cash. But because the crowd is so singularly obsessed with chasing the next speculative AI moonshot, they're completely ignoring these income-generating powerhouses. They're literally leaving an 8.7% yield right on the table, creating a beautiful, classic value opportunity for contrarian investors.
Another area hiding in plain sight is what Forbes explicitly calls the hidden opportunity: corporate spin-offs. Right now, massive legacy companies are actively breaking themselves apart. They're spinning off their non-core divisions so the parent company can focus entirely on the AI race. And here's the kicker. Historically and statistically, Forbes notes that these spun-off companies routinely actually outperform their parent companies in the first 2 years of their existence.
So the really crucial point here is understanding exactly why these spin-offs are such a good deal right now. Well, it all comes down to market mechanics. See, when a company spins off a division, massive institutional investors and index funds are often strictly mandated to sell or just dump those new shares simply to rebalance their portfolios. It's in their rules. This forced selling creates a completely artificial price drop that has absolutely nothing to do with the real value of the business. It's a very well-documented market inefficiency. For individual investors who don't have all those institutional constraints, it's a prime opportunity to grab great standalone businesses at a really steep discount. It's kind of like an insider secret, just hiding right in plain sight.
Next up is Section 4, the Fed and Insiders.
Now, let's zoom out to the macro picture for a second, because this mega rotation obviously isn't happening in a vacuum. The twin drivers of our current market conditions are monetary policy on one hand and geopolitical stability on the other. On the monetary side, we have the U.S. Federal Reserve, which just held its first rate meeting with new chair Kevin Warsh. Now, rate decisions directly impact tech valuations, right? Because higher rates make future tech profits less valuable today, which just naturally introduces some uncertainty. But then, on the flip side, investors are simultaneously watching geopolitical developments, specifically the optimism surrounding a potential U.S.-Iran deal, which acts as a really stabilizing tailwind. These two massive forces are basically dictating the pace and the direction of the capital flow.
So, let's see how these macro forces actually create an actionable signal. While the Fed sits around pondering rates, the people inside these companies are making massive moves. Executives at 4 specific high-yield tech companies are heavily buying up their own stock. And in the finance world, insider buying is widely considered one of the most reliable leading indicators of future performance. I mean, it makes sense. Executives have the absolute clearest view of their own company's prospects. When multiple insiders buy their own stock at the exact same time, especially high-yield dividend stocks, it broadcasts immense confidence in both the income security and the upside potential. It's a huge green flag.
Let's wrap all this up in Section 5, the Contrarian Framework.
All right, we've tracked the $119 billion, we've uncovered the mechanics of the rotation, and now, let's build a practical framework. First things first, here is exactly what you need to avoid so you don't fall into the same traps as the panicking crowd. You've got to stay entirely away from overhyped AI software companies that have zero clear revenue paths. Avoid any stock that is priced for absolute perfection, because let me tell you, in a rotating market, even the slightest miss is going to cause a massive correction. And finally, please stop momentum chasing at all-time highs. The money has already moved on from the peak of the hype cycle.
Conversely, here is what you should be deeply considering: the actual destinations of that $119.2 billion. Look at the picks and shovels, AI infrastructure, and essential commodities like tin. Check out that completely ignored 8.7% dividend tech yielding massive cash flow. Definitely do your homework on those artificially cheap corporate spin-offs with the strong fundamentals, and track the companies exhibiting heavy insider buying. Also, you might want to consider selective gold hedges for some stability. But listen to the warning from our sources here. Be very careful. Some gold funds look like bargains right now, but they are actually just value traps. You've got to be highly selective.
To wrap up our explainer today, I want to leave you with this final, genuinely brilliant thought from Forbes, which just perfectly encapsulates everything we've talked about. They ask, the most important question in investing: who has to sell? Think about it. Forced selling, whether it's index funds mechanically rebalancing spin-offs or panicked retail traders just getting forced out of their positions, that is what creates the absolute best market opportunities. Smart money steps in exactly when others are forced to step out. The tech boom isn't ending, folks, it's just rotating. It's rotating from hype to fundamentals. So the real question is, as this historic rotation continues to unfold right in front of us, which side of the trade are you going to be on?